7 words, delivered calmly, almost conversationally, on a stage in Portugal. And those 7 words may ultimately carry more weight for your gold and silver holdings than anything else a central banker has communicated this entire year. Because the person who spoke them was widely expected to be the one who finally delivered the easier monetary conditions markets had spent 2 years anticipating. He moved in the opposite direction entirely, and within days, the very foundation beneath his own position began to crack. There is a particular strain of American financial optimism that treats a person's history as a reliable guide to their future behavior. Kevin Warsh spent the better part of 2 years outside the institution making the case on financial television, with the fluency of someone who has absorbed every FOMC transcript since the Greenspan era, that the Federal Reserve had become excessively cautious, too slow to respond, too comfortable with inaction. He was the chairman markets had already constructed in their imagination before he arrived, the figure installed by a president who has never concealed his preference for lower borrowing costs, dressed in language that sounded restrictive but would ultimately yield. Financial markets had sketched in the policy pivot before Warsh had even settled into the role. Consider, then, the unusual theater of what followed. On July 1st, in the Portuguese hillside town of Sintra, at the European Central Bank's annual gathering of global monetary policymakers, Warsh took his position alongside Christine Lagarde, Andrew Bailey, and Tiff Macklem. An international stage, broadcast live, just weeks into his tenure. He was asked with measured politeness whether the Federal Reserve might consider tolerating inflation running modestly above its 2% objective. He did not search for a middle position. Anyone in the household sector or the business community or financial markets who believed the central bank would become comfortable operating above a 2% inflation target, he indicated, would find themselves disappointed. The commitment to delivering price stability in the United States was not conditional. Any Fed chairman making that statement would attract attention. This particular chairman making it on his first prominent international platform represented something closer to a public act of self-redefinition. But the exchange that genuinely warrants careful attention came moments afterward, when a reporter pressed him on whether he would sustain that position even with a president who appointed him wanting the precise opposite outcome. Warsh did not hesitate. The Federal Reserve has maintained its independence for a very long time, he said. It will continue to do so. No changes on that front would be visible. Read that carefully and then read it once more. It is a statement directed simultaneously at 2 separate audiences, at markets expecting an eventual rescue and at the political structure that elevated him to the position. He delivered it 2 days after the Supreme Court issued a ruling confirming that a sitting president cannot unilaterally remove a Federal Reserve governor. A legal development that had already reinforced the institution's structural independence immediately before Warsh chose a public international forum to lean into that independence deliberately. So here is the question worth sitting with. Before this analysis goes further, if you are currently holding gold or silver, what version of the Federal Reserve does your position quietly depend on? One that accommodates when genuine pressure builds, or one that holds its stated position regardless of the cost? The way institutions occasionally, memorably do? This is where the story becomes genuinely significant, and it is the dimension that most surface-level coverage failed to capture. In that same international appearance, immediately before delivering his most uncompromising statement, Warsh acknowledged something more measured. Inflation expectations, the survey data, and bond market signals reflecting what households and institutional investors believe inflation will do going forward, had actually moderated over the preceding weeks. He attributed part of that improvement to the fragile ceasefire between the United States and Iran, noting that fuel prices had been declining as that tentative arrangement held, however precariously, which means the same person refusing to negotiate on the inflation mandate was simultaneously describing an environment in which the inflation challenge might already be easing on its own, not through any Federal Reserve action, but through geopolitical development. That detail carries significance because it established precisely the kind of tension that has historically produced the sharpest and least predictable movements in precious metals. A central bank that has explicitly removed forward guidance, sitting above a genuine conflict between a mandate it says it will not compromise and underlying conditions that may be quietly shifting in the opposite direction. 72 hours later, the first significant tremor arrived. The Bureau of Labor Statistics released its June employment report, and it came in well below what the market had positioned for. The economy generated just 57,000 jobs, barely half the 113,000 to 115,000 that consensus forecasts had anticipated. The headline unemployment rate moved down from 4.3% to 4.2%, but that improvement was largely a statistical artifact. The labor force participation rate declined to 61.5%, its lowest reading since early 2021, indicating the rate fell because fewer Americans were actively seeking employment, not because more of them found it. Beneath the headline, the report deteriorated further. April and May were revised downward by a combined 74,000 positions. A meaningful portion of the labor market momentum investors had been relying on for months had not actually existed. Leisure and hospitality shed 61,000 jobs in a single month. A sharp contraction after hiring, tied to World Cup-related demand, faded. Wage growth, meanwhile, continued at 3.5% annually, a figure that complicates the picture considerably, since it demonstrates a labor market losing volume even as pay pressure has not correspondingly eased. Financial markets responded without delay. Probability estimates for a rate increase at the Fed's subsequent meeting, a two-day session beginning July the 28th, declined sharply as participants concluded that a chairman who had just delivered his most explicit inflation commitment in years might find himself unable to act on it if employment continued softening at this pace. Gold, which had been under pressure from Warsh's restrictive tone, recovered decisively, pushing above $4,980 per ounce within days. Silver moved with it, briefly reaching the low $60 range as the market concluded that one weak employment release had done more to constrain the Fed's options than any single public statement from its chairman. And this is precisely where the majority of observers are still catching up, because the sequence had not concluded. It had barely opened. Before reaching the development that reframes how this entire setup should be interpreted, it is worth pausing on a question I believe cuts to the center of why this moment matters for anyone holding either of these metals. Most investors, without ever consciously making the decision, have already chosen a position in an argument they have never explicitly had with themselves. If you are holding gold or silver expecting a straightforward restrictive environment, real rates remaining elevated, prices drifting sideways while the situation resolves, you are, whether you've recognized it or not, implicitly betting that the Iran ceasefire is genuine and durable. If instead you are holding these metals expecting a rapid reversal once weak data forces the Fed's hand, you are betting on the opposite. Very few people ever actually examine which version of events their own position requires to be true. If that question is useful, and I expect it becomes more useful the further into this we go, that is precisely the kind of framework this channel exists to work through. Just as markets were absorbing a softer labor market and a moderating inflation backdrop tied to that fragile ceasefire, the ceasefire itself collapsed. On July 8th, at a NATO gathering in Turkey, President Trump indicated to reporters that he now considered the tentative arrangement with Iran to be finished. Hours earlier, commercial vessels had been struck in the Strait of Hormuz. The United States responded with renewed strikes inside Iranian territory, its third significant military action since the ceasefire framework had initially been established in April. Iran's Revolutionary Guard conducted retaliatory operations against American positions in Bahrain and Kuwait. The U.S. Treasury moved to reimpose sanctions on Iranian petroleum exports, withdrawing the waiver that had permitted limited sales during the negotiating period. Oil markets reacted immediately. Brent crude climbed roughly 6%, moving back toward the upper 70s per barrel. And here is the connection that links directly back to Warsh's remarks in Portugal. A significant element of his case for easing inflation expectations had rested specifically on that ceasefire holding and energy costs continuing to decline. That foundation fractured within days of him citing it publicly in front of the global central banking community. Fed funds futures shifted quickly to reflect the changed environment, with the probability of a rate increase by the September meeting climbing back above 60%, up substantially from where it had briefly fallen following the weak employment report. Gold and silver, which had been advancing on the soft labor data, reversed sharply in the opposite direction. As of current trading, gold sits modestly above $4,100 per ounce, silver just above $60. Both remain elevated by any longer term historical measure. Both are meaningfully below the peaks reached only days earlier as a firmer dollar, rising near-term rate expectations, and fresh geopolitical uncertainty pull the entire complex in competing directions within the span of a single week. Consider what that sequence actually represents. In approximately 10 days, investors in precious metals watched a newly restrictive Fed chairman appear to be undermined by a weak employment report, then observed the specific geopolitical escalation he had cited as grounds for cautious optimism completely unravel, reigniting precisely the inflation risk he had been focused on at the exact moment the labor market was showing genuine signs of deterioration. That combination of simultaneous, competing pressures is genuinely unusual, and it is exactly the kind of environment that has historically not resolved itself quietly or predictably. This is also the moment to understand why silver responds so much more intensely to developments like these than gold does, because the two metals are not, whatever the marketing from precious metals dealers implies, the same trade in different packaging. Gold functions primarily as a monetary instrument, a hedge against currency depreciation and questions about central bank credibility. Silver carries that same monetary character, but it also has a substantial presence in industrial applications, solar energy systems, consumer electronics, electric vehicles. That dual identity means silver gets pulled in opposing directions during precisely the kind of tension this story describes. A restrictive Fed paired with a weakening labor market threatens to reduce industrial output, which would in theory moderate industrial silver consumption. But simultaneously, the credibility questions surrounding Warsh's commitment and the renewed inflation risk from a reignited conflict in the Middle East push the monetary dimension of silver's identity in the opposite direction. That competing pull is part of why silver has moved more dramatically than gold throughout this sequence, and it is why the gold to silver ratio currently sits near 69, meaning approximately 69 ounces of silver are required to purchase a single ounce of gold, a level some analysts regard as extended relative to recent patterns. Beneath all of that near-term volatility sits a structural picture specific to silver that has no connection to Kevin Warsh's statements and deserves to be understood independently. According to the Silver Institute's annual survey produced alongside the research consultancy Metals Focus, the global silver market is tracking toward its sixth consecutive annual supply shortfall in 2026, a deficit projected at 46. 3 million ounces, wider than the 40.3 million ounce gap recorded in 2025. Since this sequence of annual deficits began in 2021, approximately 762 million ounces have been drawn from existing above-ground inventories simply to bridge the gap between what mines and recycling supply and what global consumption actually requires. Registered inventories on exchanges in New York and London have contracted considerably over that period, reducing the buffer that would ordinarily absorb a sudden acceleration in demand. None of that structural reality guarantees silver moves in any particular direction within any given week. Near-term price behavior continues to be driven by futures market positioning, exchange-traded fund flows, and dollar movement. But it does mean that every external shock landing on this market, whether a newly restrictive Fed chairman or a ceasefire that dissolved within weeks of being signed, is arriving in a system with less capacity to absorb disruption than it carried 5 years ago. Here is the question that deserves serious attention now, because most coverage of this story stops before reaching it. If oil remains elevated because the Iran situation has genuinely re-escalated, does Warsh now have greater institutional cover to sustain his restrictive position even as the labor market continues softening? Or does a deteriorating employment picture eventually force a policy adjustment regardless of what energy costs are doing, leaving him to defend a public commitment the underlying data no longer fully supports? Neither Warsh nor anyone in a position to know has provided a definitive answer, and he has been unusually disciplined about withholding one. Since assuming the role, he has reduced the length of the Fed's public communications, declined to submit his own economic projections, conducted fewer press interactions than his predecessors, and explicitly rejected the practice of signaling future policy intentions in advance. He has additionally established 5 separate internal review groups to reconsider how the Fed collects economic data, evaluates inflation dynamics, communicates with the public, and manages its balance sheet, changes he has described as both timely and necessary. There is a historical comparison worth examining carefully here, including the ways it does not hold up under scrutiny. Paul Volcker, leading this Federal Reserve in the early 1980s, made his own uncompromising public declaration that he would break entrenched inflation regardless of the political or economic consequences. That commitment was tested almost immediately by a severe recession. For an extended period, it appeared the pressure to change course might succeed. It did not. Volcker maintained his position through years of genuine economic hardship, and the institutional credibility he established by refusing to reverse course became the platform the Fed operated from for the following 2 decades. But notice what that episode actually required. Sustained willingness to accept real economic pain over an extended period, not a single forceful sentence delivered at one international conference. Warsh has now produced his own version of that uncompromising language within his first 2 months in office, confronting a labor market that began showing cracks within days of his public statement, rather than months or years into a deliberate tightening campaign. Whether his resolve survives its first genuine test the way Volcker's eventually did, or gets modified once political and economic pressure genuinely intensifies, remains an open question, and it may remain open for months. The more skeptical interpretation also deserves serious consideration, because dismissing it would be analytically incomplete. Several economists have observed that Warsh spent nearly 2 years publicly arguing for lower rates before accepting the chairmanship, and that his current restrictive rhetoric may reflect the specific circumstances he inherited. An inflation episode driven substantially by a Middle Eastern conflict, rather than a permanent shift in his underlying framework. Under that reading, his current position is less a multi-year ideological commitment in the Volcker tradition, and more a situational stance that could shift again if energy costs eventually stabilize and the broader inflation picture continues improving. That is not an unreasonable interpretation of the available evidence. And Warsh himself, in that same Portugal appearance, provided material supporting both readings simultaneously. Restrictive language paired with an acknowledgement that underlying inflation pressures had, at least momentarily, been easing. That distinction matters considerably for how you think about gold and silver from this point forward, because the two scenarios point toward meaningfully different outcomes. If Warsh's resolve proves genuine and lasting, precious metals investors should expect a Federal Reserve willing to tolerate real near-term economic discomfort, including further labor market deterioration, in order to preserve its own credibility. An environment that has historically supported gold and silver over longer timeframes, even while producing difficult and volatile price behavior along the way, as real interest rates remain elevated. If instead his position proves more conditional than his language suggested, investors could see a much more rapid shift toward accommodative policy the moment the data confirms both moderating inflation and a genuinely weakening labor market, a scenario that has historically been even more powerfully supportive for both metals